Most people missed what happened this week. While financial headlines focused on quarterly earnings and the usual noise from Washington, something far more significant occurred in the global monetary system. Central banks continued accumulating gold at a pace not seen in over 50 years. Meanwhile, registered silver inventories on the COMEX dropped to levels that, just 3 years ago, would have been considered a structural crisis. This is not panic, this is a pattern. And patterns, when they persist long enough, eventually become undeniable. What makes this moment different is not any single data point. It is the convergence. When you see central banks acting one way while telling markets to expect another, when you see physical metal leaving vaults while paper contracts multiply, when you see institutions quietly adjusting their risk models while publicly maintaining confidence, you're witnessing something that deserves careful attention. The surface of the market appears calm. Equities remain elevated. Credit spreads suggest corporate health. Unemployment figures remain manageable, but underneath that surface, pressure continues to build in ways that most investors are not tracking. And if history offers any guidance, it is precisely when the surface appears calmest that the pressure beneath becomes most dangerous. To understand what is developing, we need to step back and examine the environment that has brought us to this moment. Interest rates remain elevated by historical standards, though not at the extremes that characterized early 2023. The Federal Reserve has paused, signaling patience while quietly managing a balance sheet that remains enormous by any reasonable metric. The federal debt continues to expand at a pace that would have seemed impossible just a decade ago, with interest payments now consuming a larger share of tax revenue than at any point in modern history. Liquidity, the lifeblood of modern financial markets, has become increasingly bifurcated. Large institutions with access to Federal Reserve facilities enjoy ample access to funding. Smaller banks and regional institutions operate under considerably more stress. The reverse repo facility, which at its peak absorbed over $2 trillion in excess liquidity, has drained substantially. This matters because it means the cushion of excess reserves that allowed the system to absorb shocks is thinner than it was 18 months ago. Meanwhile, institutional positioning has shifted in subtle but meaningful ways. Asset managers with fiduciary responsibilities have begun to increase allocations to hard assets, not dramatically, but consistently. The pension funds and sovereign wealth funds that operate on decades-long time horizons are not making headlines with their purchases. But their steady accumulation of physical gold tells a story that their public statements often do not. This brings us to the pressure point that most observers have failed to fully appreciate. The stress is not appearing where people expect to see it. It is not in the stock market, which remains supported by passive flows and algorithmic rebalancing. It is not in high-yield credit, where spreads remain historically tight. The stress is appearing in the plumbing of the system, in the overnight lending markets and the Treasury auction dynamics, and in the persistent gap between paper prices and physical availability. Consider the Treasury market. The United States government must refinance trillions of dollars in maturing debt while simultaneously funding ongoing deficits. Foreign central banks, once reliable buyers of American government debt, have become net sellers over the past 2 years. The domestic banking sector, burned by duration mismatches that contributed to the regional banking crisis, has grown more cautious about loading up on long-dated bonds. This leaves the market increasingly dependent on hedge funds employing leveraged basis trades, a structure that works beautifully until it does not. The Federal Reserve understands this fragility. That is why, despite rhetoric suggesting a commitment to quantitative tightening, the actual reduction of the balance sheet has proceeded more slowly than initial projections suggested. Emergency lending facilities that were supposed to be temporary have been extended. The Bank Term Funding Program, created in response to the Silicon Valley Bank failure, provided a pressure release valve that prevented what could have become a cascading crisis. These are not the actions of a central bank operating from a position of strength. Regional banks continue to carry unrealized losses on their bond portfolios that would render many of them technically insolvent if marked to market. Commercial real estate loans, particularly those tied to office properties in major metropolitan areas, are beginning to roll over into a market where valuations have declined substantially. The extend and pretend strategy that has characterized much of the commercial real estate sector cannot continue indefinitely. Eventually, loans must be refinanced or written down. This is where gold and silver become relevant, not as investments to be recommended or avoided, but as instruments that have historically responded to monetary system stress before that stress becomes visible in conventional financial metrics. Gold's persistent strength over the past 18 months has puzzled many mainstream analysts. With real interest rates positive and the dollar relatively stable against major trading partners, traditional models suggested gold should face headwinds. Instead, prices have moved to levels that would have seemed implausible just 5 years ago. This divergence between model predictions and actual behavior suggests that something is occurring that the models are not capturing. Central bank purchases offer a partial explanation. China, Russia, Poland, Singapore, and numerous other nations have been adding to their gold reserves at an extraordinary pace. These purchases are not speculative. They represent strategic decisions made by officials who have access to information about the stability of the global monetary system that private investors do not. When the People's Bank of China systematically increases its gold holdings month after month despite already holding substantial reserves, it signals something about their assessment of long-term dollar stability. The paper gold market, dominated by futures contracts on the COMEX and positions in exchange-traded funds, has historically served as the price discovery mechanism for the metal. But the relationship between paper prices and physical availability has grown increasingly strained. Premiums for physical delivery have expanded during periods of stress. Registered inventories available for delivery have declined to levels that raise legitimate questions about what would happen if a meaningful percentage of contract holders demanded physical settlement. Silver presents an even more complex picture. Unlike gold, which is primarily a monetary metal, silver serves critical industrial applications. Solar panel production, electronic components, medical devices, and emerging battery technologies all require silver inputs. Global mine supply has failed to keep pace with industrial demand, creating a structural deficit that has persisted for several years. Above-ground inventories that accumulated during decades of surplus have been steadily depleted. The COMEX silver inventory, which represents metal available for delivery against futures contracts, has fallen dramatically from its peaks. This decline has occurred gradually enough that it rarely makes headlines, but the cumulative effect is significant. The buffer that once existed between the paper market and physical scarcity has narrowed considerably. This dynamic creates an interesting asymmetry. In the paper market, large financial institutions can establish short positions that would be impossible to replicate in the physical market. The argument that these positions represent hedging by mining companies or legitimate commercial activity has become less persuasive as the concentration of short positions has grown among a small number of large banks. Whether this represents manipulation, hedging, or simply market structure is a matter of ongoing debate. What is not debatable is that the relationship between paper claims and physical metal has grown more tenuous. Historical parallels offer useful context, though they must be applied carefully. The London gold pool of the 1960s attempted to maintain a fixed gold price of $35 per ounce through coordinated selling by Western central banks. The pool functioned effectively for years until the underlying monetary imbalances became too large to suppress. When the pool collapsed in 1968, gold began a decade-long repricing that saw its value increase more than 20-fold. The conditions today are different in important ways. Gold is not formally tied to currency values. Central banks are not defending a specific price. The mechanisms have changed. But the underlying dynamic, an attempt to maintain confidence in paper claims that are expanding faster than the real economy can support, bears resemblance to earlier periods of monetary stress. The 1970s showed how quickly apparently stable systems can become unstable when confidence erodes. The stagflation of that decade emerged from a combination of loose monetary policy, supply shocks, and accumulated imbalances that had built over the previous decade. Those who positioned early for that transition preserved purchasing power. Those who trusted the official narrative that inflation was transitory suffered significant losses. The 2008 financial crisis demonstrated how interconnected the modern financial system has become and how quickly liquidity can evaporate when participants lose confidence in counterparty solvency. The interventions required to stabilize that crisis created the foundation for the monetary expansion that followed. Each crisis response has been larger than the last, and each resolution has left the system more leveraged and more dependent on central bank support. This pattern of intervention and expansion cannot continue indefinitely. At some point, the accumulated imbalances must resolve. History suggests they can resolve gradually through sustained inflation that erodes the real value of debt, or suddenly through acute crisis that forces rapid repricing. The path that unfolds depends on decisions that have not yet been made and events that cannot be predicted with confidence. What comes next remains genuinely uncertain. Several scenarios deserve consideration, not as predictions, but as possibilities that prudent observers should contemplate. If central banks successfully engineer a soft landing, gradually reducing inflation while maintaining employment and avoiding acute financial stress, then the current monetary order could persist for an extended period. This would likely mean continued moderate appreciation in gold prices, reflecting ongoing central bank accumulation and gradual dollar depreciation, but not the dramatic repricing that some anticipate. If inflationary pressures prove more persistent than current projections suggest, central banks may face an uncomfortable choice between crushing inflation with rates high enough to trigger severe recession or accepting a higher baseline inflation rate that gradually erodes living standards and bond values. Either path would likely support precious metals, though through different mechanisms. If a credit event triggers acute financial stress, whether originating in commercial real estate, sovereign debt, derivatives exposures, or some entirely unexpected source, the system's response would likely follow the established playbook. Emergency liquidity provision, facility creation, and implicit or explicit guarantees would be deployed to prevent cascading failures. Each such intervention expands the monetary base and reinforces the pattern that has characterized central banking for the past 15 years. Metals have historically responded positively to such interventions, though often with a lag. The scenario that deserves perhaps the most attention is the gradual erosion of confidence in the dollar's reserve currency status. This would not occur suddenly. It would manifest as a slow reduction in dollar holdings by foreign central banks, a gradual shift toward bilateral trade agreements that bypass the dollar, and an incremental increase in gold's role as a neutral reserve asset. This transition is already underway. Its pace and ultimate destination remain uncertain. What remains clear is that the signals emerging from physical gold and silver markets are telling a story that diverges from the narrative of stability projected by official sources. The gap between what institutions say and what they do deserves attention. Words are cheap. Actions, particularly actions taken by sophisticated actors with access to superior information, carry more weight. The purpose of examining these patterns is not to generate fear or encourage hasty action. It is to encourage awareness. Markets that appear stable can remain stable for extended periods. The timing of transitions is notoriously difficult to predict. Many who have anticipated systemic stress have been early, and in markets, being early is functionally equivalent to being wrong. But awareness of underlying dynamics allows for more informed decisions when circumstances change. Understanding that central banks are accumulating gold while encouraging public confidence in fiat currency provides context that pure price analysis cannot capture. Recognizing that physical inventories are declining while paper claims multiply allows for more realistic assessment of where true value resides. The monetary system that emerged from 2008 has been remarkably resilient. It has absorbed shocks that would have seemed catastrophic in earlier eras. The combination of aggressive central bank intervention, implicit government guarantees, and sophisticated financial engineering has maintained stability far longer than many skeptics predicted. This resilience should not be dismissed. But resilience and permanence are different things. The Roman monetary system was resilient for centuries before its gradual debasement contributed to imperial decline. The Bretton Woods system appeared unshakable until it collapsed. The assumption that current arrangements represent a permanent state of affairs is itself a form of historical blindness. Gold and silver make no promises. They offer no yield. They generate no earnings. They simply persist, maintaining their physical properties and their purchasing power across centuries of monetary experimentation. Their prices fluctuate, sometimes dramatically. Their utility as short-term trading vehicles is questionable, but their track record as stores of value across the long arc of history is unmatched. The choice of how to interpret these signals and what, if anything, to do in response belongs to each individual. This is not advice, it is observation. The patterns are visible to anyone willing to look beneath the surface noise of daily financial news. Something is developing. Whether it represents opportunity, risk, or simply the ordinary functioning of markets adapting to changing conditions cannot be determined with certainty. What can be said is that attention is warranted. The signals are real, the patterns are persistent, and history suggests that those who remain aware of underlying monetary dynamics are better positioned to navigate whatever comes next than those who accept surface appearances at face value. The calm on the surface should not be mistaken for stability underneath. Pressure continues to build. How and when it releases remains to be seen. But the indicators are there for those willing to read them.